Welcome back to the channel. Today, we're diving into one of the most surprising developments in global finance, how U.S. tariffs, policies often associated with trade wars and global tensions, are unexpectedly supporting the U.S. bond market. We'll explore why tariffs, normally seen as a drag on growth, are now being viewed as a stabilizing force for U.S. Treasuries, and what this means for investors and policymakers. Traditionally, tariffs are viewed as inflationary. They raise the price of imports, which reduces consumer purchasing power and can distort global supply chains. Investors often worry that tariffs slow growth while increasing costs, creating a lose-lose scenario. But in the current economic environment, something unusual is happening. Tariffs are generating massive government revenues, estimated at up to $3.3 trillion over the next decade. And this revenue is playing a critical role in reshaping the U.S. bond market. Here's the twist. Despite high U.S. debt levels, tariffs are helping boost investor confidence in treasuries. How exactly? Let's break it down into three key points. 1. Revenue stream. The tariffs function like a steady tax on imports, creating predictable cash flows for the government. This reassures investors about America's ability to service its debt. 2. Relative attractiveness. Global bond markets have been under pressure, but U.S. Treasuries remain the world's most liquid and trusted asset. With tariffs strengthening fiscal inflows, they look safer compared to alternatives. Chapter 3. Policy shielding. In effect, tariffs act as a financial buffer, supporting U.S. bonds even when traditional risks like high deficits would normally spook markets. Still, the picture isn't uniform. Analysts talk about a tale of two bond markets. Short-term treasuries have rallied strongly as markets price in future Federal Reserve rate cuts, while long-term yields remain elevated. Tariffs are especially supporting the short to medium-term outlook, giving investors confidence in near-term government financing. But the long end of the curve is still flashing warning signs about long-term debt sustainability. Of course, not everyone is convinced. Critics argue that tariffs are ultimately a tax on consumers and businesses, and that their inflationary effects could undermine the very bond market stability they appear to support. Others point out that relying on tariffs to fund government spending is risky. If trade flows shift, tariff revenues could decline, exposing vulnerabilities in the fiscal outlook. So what's the bottom line? U.S. tariffs, long seen as a negative force, are now acting as an unexpected support mechanism for the Treasury market. They provide a revenue cushion, reassure investors, and strengthen short-term bond demand. But the long-term story remains uncertain. For investors, this is a reminder that in financial markets, cause and effect aren't always straightforward. Sometimes the very policies designed for trade leverage end up reshaping global capital flows in surprising ways. Thanks for watching. If you found this breakdown helpful, make sure to like, subscribe, and leave a comment with your thoughts on whether tariffs are a sustainable solution for the U.S. bond market.